There we go. Awesome. Welcome everyone. Please come on in. I know some of you have been waiting for a minute, so welcome. We'll give it a few minutes here before I introduce Thomas and Cendana and get the conversation started. Feel free if you are, I'll go ahead and put in chat here where everyone's based and calling in from. Usually get people all over the world for our live streams, which is great. Let me go ahead and put I'm like here. Chicago. We'll get started here in two to 3 minutes. Thomas, how was your Labor Day?
It was good. It's funny, summer just flies by so quickly now. And so it's a sad end to it, but it's good. I'm on the East Coast in the New York area, and so this is one of the best times for events, weather, and so it's nice to get the fall kicked off.
Nice. Oh, what's up, Hillary? Kristen in Iceland. I went to Iceland last year. It was incredible. Nico's in Spain. Awesome. London, very awesome. What else we got here? Chicago. Oh, hello, neighbor. Riyadh. Cool. We got people all over. We'll give it one more minute. Hey, Mitch. Boston, Miami, Austin, Paris. Here we go. Uh, is it true or Thomas? Like I was just talking to Jenny Fielding from Everywhere on a podcast we also host, and we were talking about the fundraising environment between now and Thanksgiving. For founders, is that true for fund managers as well, like GPs raising capital? Do the timelines kind of match the founder cycle, or is it different?
Yeah, I mean, I would say, look, folks are fundraising all year. Obviously, like fundraising takes a longer period of time than a lot of folks that are kicking off company raises, and so they tend to be elongated. I think one of the interesting tidbits is kind of like LP budgets tend to work in calendar years. So I actually think there's like a larger contingency of folks that like kick off or more meaningfully raise in the first half of the year, and then the
Okay.
second half of the year ends up being like final closes, kind of pushing folks to the finish line. But yeah, it's definitely active post
Yeah.
Labor Day for sure.
Okay. Awesome. Well, we're gonna get started here, everyone. Come on in. We're gonna go through some housekeeping and Q&A, and we're gonna dive into the topics today. But my name is Mike Pruce. I'm the founder of Visible. If I don't already know you, thanks for spending some of your day with us. And Thomas, thanks for spending your time with us today and sharing some of your insights. We already got a great one even before we dove into our content. And just a quick bio about Thomas. Thomas is a principal at Cendana, where he invests in emerging pre-seed and seed funds. Prior to Cendana, he was at Cambridge. I'm sure a lot of you have used Cambridge data yourselves in your own fundraising or your own research. So he has 8 amazing years with institutional LP experience, evaluated thousands of funds in different stages, sectors, geographies. I've had a chance to meet with the Cendana team over the past 6 months and meet with Thomas. And I'm just really excited to share a little bit about Cendana, a little bit about Thomas, and all of the knowledge he has to offer everyone here. So, Thomas, welcome. Anything I missed there? And I would love just to kind of have you tee up and give us a little quick intro about Cendana as well.
Yeah, of course. Well, Mike, thank you so much for the kind intro and to everyone on the call. It's great to connect. Looking forward to a really enjoyable conversation here. No, I mean, you hit everything. Look, I've been an institutional LP for the past 8 years. I've covered funds from pre-seed through growth equity. And here at Cendana, we're a pre-seed and seed focused venture fund to fund. We've been around for over a decade. You could see some of the summary stats here, but we've backed 200 plus funds, 80 plus fund managers. We're really think about kind of how the role we play as an LP. We like to think of ourselves as kind of the lead investor in our funds, and we work incredibly collaboratively and closely across, kind of our GPs and our LPs. Um, and at the end of the day, our relationships and our data are such a big part of our kind of fund to fund business. But it also powers to kind of additional strategies. We've got both a secondaries fund and a co-investments fund. I think we're going to talk a little bit about kind of secondaries, which is a hot market topic right now. And so we're just excited to jump in.
Yeah, I love it. we're also going to share a few podcasts and recordings out with our audience today about the history of Cendana, kind of one of the innovators in the emerging manager fund to fund space. So you can go and check out that content when we send that out. Our team will put that in chat. We'll also follow up with that material as well. Kind of moving on really quickly. I see a lot of familiar faces here, but for those of you that are not too familiar with Visible, we started the company over 10 years now ago, which is crazy, and made a really intentional choice on becoming a profitable SaaS company so we can best serve both founders and investors and give them tools to kind of really equip them and then make them thrive. We work with over 620 venture funds all over the world. Some of you guys see in this call here. Some of those are the GPs of Cendana, which is actually how we got connected originally. And yeah, just really excited and grateful that everyone is spending a little bit of their time with us here today. Real quick, this is being recorded. I think we usually get that as a question. So this is going to be recorded. That will be produced with a recap at the end. So we'll send that out usually within a week, if not sooner. I don't want to give our marketing team a deadline of tonight, but you'll get a recap of this. So if you have to bounce a couple minutes towards the end, we will send that out to all of you. One of the things that teed off this conversation was I had the chance to chat with Leo, who was one of the founders of SUSE Ventures and now the GP at Humba. And one of the things we asked for in our recent podcast is like one relationship that's changed your life. And he shouted out Cendana, and I was like, hey, let's go talk to them and see what they're all about. And he's like, hey, I think they are some of the people that created the category and how we're teeing things off here. And one of the things I talked to Leo about was like the shifting market and early stage um and Thomas, I know we talked about this a little bit, but I would love to get your opinion on what are the biggest changes like in the seed market since 2020? That was only 5 years ago, which kind of seems like it was just here and forever ago. But at the same time, like what have you seen change in the seed market in the last 5 years?
Yeah, I mean, it's funny. We were talking about this even kind of before, and we were like, how has seed changed since Cendana was started? And we kind of landed on, since 2020, because even over the past 5 years, we've seen such significant transition across a number of different facets in the market. I would say seed today is kind of closer to an efficient market than it ever has been. I think that's evidenced in prices being paid, the number of funds that are chasing deals, 10 companies building the same solution, many of which can be spun up quite quickly. And I think that's even reflected in kind of our own data. I think the median seed round in the Cendana portfolio in Q1 was kind of 5 on 24 posts. And I think if you look back at, what some of these rounds looked like even 5, 10 years ago, like you could argue when Cendana was started, that was a Series A. And so the kind of nomenclature and round names I think are all a little bit blurred right now in the current market. I think one of the other dynamics that has played a big role in how the seed market has shifted in recent years is kind of the involvement of the multi-stage and platform funds who view a lot of their seed investing as kind of early option bets, especially in AI. I think, there's different data sources that have, quoted round size premiums north of 100% in at seed and AI and valuations at north of 60%. And so those have changed kind of how the game on the field is played within the seed environment. And then there's other new phenomena that I think have, been introduced to the market that also have impacted not only prices, but how companies get funded. Things like companies skipping rounds entirely. So, raising an A out of the gate or going from seed to Series B because these companies can hit meaningful traction so quickly. And then the other dynamic, and one of our GPs actually flagged this yesterday, is compute costs for a lot of these companies are almost being priced into seed rounds. And so you're paying not only the classic seed round price, but you're paying for some of that compute. And I think maybe the last thing I would share is kind of given how efficiently these companies can be built, founders are more dilution sensitive to than ever, and they've got more pricing power, especially when there's, kind of a whiff of heat around them. And so I think that keeps some of these prices artificially inflated, but it also means it's a more competitive dynamic for less access into these rounds. And so seed funds have to be even more aware of that than ever to kind of maximize their ability to meaningfully access these companies.
What kind of advice are you giving the GPs you work with on getting access and winning deals in the it sounds like a competitive market that's working pretty efficiently.
Yeah, I mean, it's such an interesting topic because it's actually led to a lot of refinement in our own approach. And a big part of that is kind of driven by data where, we look at kind of historical trends. We look at, what different fund profiles in our own portfolio have outperformed. And I think some of the strategic shifts we've looked at is like smaller, more flexible, more collaborative funds have a greater likelihood of being able to access some of these companies. And I think constructing your portfolio and fund size in a way that brings that flexibility is a new dynamic. I think the other question that we're getting from a lot of our funds is, they might have access to some of these things, but it might not be the perfect allocation or it might not be the exact price that they're willing to pay. And I think we're pushing them a lot more on like, hey, do you think this is something that can be a generational outcome? Is it something that can produce a mafia? Is it something that can meaningfully move the needle for the fund, even if, the portfolio math isn't perfect? And so kind of moving away from being a little bit too rigid on that to kind of maximize your opportunity to gain access to these companies, having, a portfolio that looks maybe a little bit more like core and non-core, where you've got a subset of the portfolio that allows you to invest, maybe slightly smaller checks or at slightly higher prices where you believe this could be a really important generational company. And then the last piece that I would share is we've guided funds towards actually a slightly more diversified portfolio. I would say
Hmm.
the historical days of Cendana, we were very, focused on concentrated portfolios. And I think that looked a little bit differently across different folks. And I think if we look at some of the very highly concentrated portfolios, folks that, invested in 10, 12 companies, you just don't have enough shots on goal in an efficient market today to capture what we think are the power law outcomes that drive the performance for these funds. And so having a slightly more diversified portfolio is another great way of finding a solution to that. And then the last piece here is around kind of how folks think about reserves. We've actually guided a lot of our funds to be a little bit more initial check heavy as opposed to kind of reserve centric, because you want to make sure you have the ability to get into these companies at the lowest prices where there is a little bit more access, because as they get hot, as they start to get a lot of interest from other funds, they get bid up, the valuations get out of control, and it can become hard for these positions to still be meaningful to the fund.
Interesting. What about recycling and how does that interplay with your like any of the recent, in the last 5 years or just your math in general? You mentioned reserves, and then I know recycling is a hot topic as well.
Yeah, we're big on recycling. We guide our funds to have, call it 120% of their fund be able to be invested with recycling. I think as we see some of these early acquisitions of folks where, they're kind of trying to bring talent into some of the bigger organizations, or, some of the companies that, maybe aren't home runs and, they end up being singles or doubles and they could produce some early liquidity. I think it's a great way for fund managers to get closer to 100% invested. That's certainly what LPs want to see. We want as much capital going into companies as we can. And I think it gives folks a lot more flexibility to, again, diversify the portfolio slightly, and kind of pile some of the capital back into either the winning companies or maybe buy another shot or two on goal.
You mentioned diversification here a few times. What does that look like in practice? Are you talking about diversifying like the sector, the stage, location, check size, all of it? Like, if there's like a few key things that I should be thinking about as an emerging manager, like what should I be thinking about when it comes to diversification?
Yeah, so the diversification I'm thinking is actually number of companies.
Okay.
Having a wide enough breadth within the portfolio where you feel like you've got enough shots on goal that you can capture these historical kind of outlier outcomes. I think folks that, believe they're 2 to 3x better pickers than the broader market and so are building 10, 12 company portfolios. I think that's a hard game to play. And so, the portfolios that have, call it, somewhere 30 to 40 companies, we think, gives you enough of a coverage within the market to kind of capture those different outlier outcomes.
I love it. Last question here before we move on to secondaries and some of the other topics we were just chatting through. But how are you guys refining your approach now? You're on Fund 6 here. A lot of learnings over the past 13, 14 years. You touched on some of this, but anything else worth mentioning in terms of how you're refining your own approach and finding GPs?
Yeah, I think I shared a good amount of this, but maybe to put like a little bit more of a fine tooth comb around some of it, like around these smaller, earlier funds, the median fund size in kind of our fund six, which is the current fund to fund we're deploying, is about 45 million. And so that's probably a market difference from, maybe some of our historical portfolios where that number probably looked more like, call it 60 to 70 million. And then an even more of an emphasis on, call it, funds one through three. And so finding these earlier vintage funds where, we think there's an opportunity to capitalize on this. I think, again, kind of a lot of this is driven by our own data where, these earlier funds, these smaller funds have pretty consistently outperformed across our portfolio. Again, kind of these, slightly wider portfolios with the lower reserve ratios. And then one of the other like really interesting dynamics, most of our funds are lead majority, but the ability to bake in that collaborative approach as part of the portfolio has become a little bit of a hallmark in our portfolio funds. And I think that's a historical shift from a lot of our earlier funds where, 90 to 95% of the deals were kind of lead situations for our portfolio funds.
Yeah, I love it. We're gonna move on here. Again, if anyone has questions, feel free to throw them in the Q&A chat. We'll get to them either live if it makes sense, or we're definitely gonna have some time at the end. So welcome any questions. Moving on. One of the other conversations that we just posted this, I think, believe today, was posted live, our chat with Hunter, which is a really interesting one. And I've been fascinated by secondaries now since the start of the year. Um, and they've always, like, to me, have had, and this is a direct quote from Hunter, usually reasons of distress or circumstance. Um, but he said, like, those set of circumstances don't get you to 71% of VC exits. So there's big shifts happening in the market. Meaning, like, before it was like a kind of a taboo thing, and now it's like a common strategy. Um, and I guess just to kick the things off here, Thomas, um, how are these changing the way LPs and you think about commitments to early stage funds? Like, how is this playing a role in your own, liquidity within the funds, or how you're thinking about it and deploying in future funds?
Yeah, secondaries is such an interesting topic. I think it's become a central part of the story for early stage funds when we think about liquidity, which is obviously top of mind for almost every LP. And I think in particular for the fund Cendana backs, they've got a unique structural advantage because, in a robust secondary market, they enter early at low prices, and most importantly, they're not viewed as kind of meaningful signal if they end up selling into these, larger, higher price rounds at Series C, D, E plus. And so I think it's going to become a really important tool for these early stage funds to help de-risk some of their portfolio, to take some of the gains off the table, while still holding enough of a position that, this can still be a needle mover for them. The founder of Sedona, Michael, went into detail with this with another podcast, but we typically guide folks to about 20 to 30% as kind of de-risking, where in a lot of cases, these are, meaningful fund value drivers, if not, worth multiples of the fund. And so that 20 to 30% can represent anywhere from 50 to 100% of returning the fund, which is obviously meaningful to LPs. We've had one fund manager recently that returned, 1.25x their fund on a partial secondary in a big company, and they still hold almost 10%. And so we think as a fiduciary, it's good de-risking. It provides LPs with early liquidity, but it still doesn't like cap the upside potential that you have. And I think, kind of to the point you were making earlier, This is a very big distinction. Secondaries today are not for middling assets in a portfolio or a way to kind of sell off a long tail for these early stage funds, especially earlier in the life cycle. These are about, the outlier performers where there's a bunch of pent-up demand for these assets, especially, if they're ahead of kind of a material exit event. And it gives these fund managers an opportunity to capitalize on being early backers of these winners and take some money off the table.
Yeah, it's fascinating. Do you think it's like here to stay? Is this become a standard playbook, or is this just because liquidity's been hard to get? IPO one has been shut for a while. Like, where is this? Yeah, is this like a fleeting thing, or going to be a strategy moving forward?
Yeah, we think it's here to stay. I think, kind of the way, the historical outcomes were maybe IPO and M&A. I think secondaries is going to become that third leg of the stool, especially for these early funds. I think it's a little bit more challenging for the later funds because of the signaling risk, and kind of when they enter. But for early stage funds, yeah, I think it's just going to be a piece of kind of portfolio management. I think the market is robust enough that and here to stay in terms of buyers, especially for the higher quality assets. And I do think from the LP perspective, as companies stay private longer, as venture fund lives have pushed to 12, 13, 15 years, before, there is, kind of a meaningful liquidation of the funds, I think it's a really important tool to help bring some of that capital back into the market. And hopefully that powers additional fundraising for funds where LPs have this early capital to kind of plow back into the venture industry.
Interesting. We chatted about IPOs a little bit here. There's talk of the IPO, reopening. We had Figma, Chime recently. Does that shift expectations for distributions in the next 12 to 24 months? How is that influencing some of your decision making?
Yeah, I mean, there's definitely signs of opening. We've had several IPOs in our own portfolio that have fared reasonably well in public markets. There's been a steady stream, kind of you mentioned Figma, Chime, CoreWeave, others. And so it definitely feels like there are signs of it. I would say that said, we're still well behind where I think most LPs expected us to be at the start of 25. I think the macro environment played a big part of that with kind of tariff and interest rate uncertainty. Um, but I do think, there's a whole wave of companies kind of lined up for, call it Q4 or the first half of 26. And I think most of those are going to be the higher quality, clearly IPO ready assets that maybe in a more favorable environment had gone public, 18, 24 months ago. And I think the hope is, yeah, that should bring kind of a much needed inflow of distributions back to LPs kind of as that proceeds.
Yeah. Okay. Jeremy just wrote in a great question we'll answer live. I saw the other few others come in, so thanks for those. We're going to get to those for sure. This one's directly related to we just talked about timeline and intervals of funds going 13, 15 years. How does Cendana view other fund structures? Evergreen funds, interval funds, et cetera, with like the lengthening of timelines.
Yeah, I mean, I can't say it's anything we've backed. It's not something that I think any of our fund managers have considered. I think for very early funds that we back, the structure of kind of the 10-year fund life with extensions, I think builds in the patience to be able to build these companies the right way. I think if we look back at kind of our historical data, year seven-ish is kind of when, more meaningful DPI tends to start coming for our fund managers. And so we want to build in that patience and you want kind of the LPs that are aligned with that. I think, they're rolling in interval funds that I think are alternative ways to get funding, especially in a challenged environment and, gives even more permanent capital to folks that are deploying. But I think it can create a little bit of pressure around, when is the right time to sell and being a little bit more of a market timer. And certainly like ensuring, not necessarily ensuring you've got the right patient capital around you to build these funds into, the high performing assets that we know they can be.
Yeah. Um, you guys have written about this, and there's been a lot of talk about the flight to quality in venture. How is that shaping the types of GPs that are able to raise capital? And you, I think, it mentioned around seed funds need to pick a lane related to that. Like, what does that mean in practice, and why is it more important today?
Yeah, I mean, this could not be truer, and it's certainly from the fundraising side, it is widely evidenced. I think PitchBook says it's like 12 VC funds have captured, 50% plus of capital in the first half of 25, and the top 30 attracts, 75% plus. So it's very clear on that fundraising side. And I think on the emerging manager side, like that data is like they're attracting less than 30% of capital, and first time fund manager capital raised is at a decade low. And so there's no question that from like the fundraising side on the fund side, that capital is being parked in areas that are perceived as safer or kind of more understood. I think this extends to company funding as well. I think there's a clear bifurcation in the market. A lot of people have kind of talked about it in like haves and have-nots, and the reality is the haves are very consensus bets. They're pedigreed founders building in hot AI categories that are being chased by all the multi-stage funds. I think one thing that feels a little bit different is a lot of really smart investors are actually betting that you can make money being consensus. I think, the idea that some of these AI companies are going to be producing outcomes that are totally transformational, and, it's okay if they enter at, a nosebleed price because they believe these companies can just be totally massive outcomes. And maybe some are. I think there's going to be a lot that aren't. But I do think that's another thing that's driving this haves and have-nots is kind of the idea that you can be right and consensus. Um, and yeah, I mean, this is where, we've guided a lot of our seed funds where you kind of have to pick a lane. You can either, hold your nose and invest in these high-priced rounds and build that collaborative approach, or, you could kind of go to the roots of what, true early stage investing is, which is trying to uncover, non-consensus or undiscovered opportunities before the market is aware of them. We've seen both. I think a big part of this ties into, how you think about portfolio construction dynamics that I shared earlier. Obviously, if you want to be collaborative and flexible to invest in these companies, you've got to have the underlying portfolio model and fund size that allows for that. I think the worst case outcome is, for these emerging seed funds is, if you end up going head to head with the Sequoias of the world on a consistent basis, I think that's kind of a recipe for disaster for those funds.
One kind of related and final question, which is going to be a great transition to our next slide about raising Fund One, which I imagine a lot of our audience here is going to be excited to hear about. How do you compare like the ideal GP profile that you maybe looked at in 2020 versus what you're looking at today in 2025, soon to be 2026?
Yeah. So we back a lot of ex-founder operators. I think it's about kind of 60 to 65% of our portfolio. And one thing we're spending more time on than ever is how those skill sets atrophy over time in such a high-paced environment
Mhm.
of innovation. I think, we used to think these had kind of historical shelf lives, and I think that's changing where we need a really strong reason why we feel like, this operating skill set or founder background endures through cycles. And in a lot of cases, that means folks that are still actively building, whether that's, internal sourcing tools, or we have one fund manager that says, she kind of meets founders on GitHub because she's building herself. And so, how some of that evolves to make sure you're remaining relevant and valuable to founders. We talk a lot about evolving network advantages too, which are probably
Mhm.
more important now than ever. We'll get into this a little bit more with Fund One because this is a huge piece of what we underwrite for. But where founders are coming out of look different. There's hacker houses or young founder communities like Teal Fellows, and the new wave of leading companies like OpenAI that are producing really strong entrepreneurial talent. And the complexion of GPs that source out of these look a little bit different, even as than they did in 2020. And then the last piece, and I feel like this is kind of hitting the nail on the head because we've referenced it a couple times, but folks that can adapt to playing the game on the field. I think, we talked about how much
Hmm.
venture has changed since 2020, especially at the seed stage, and being able to move with the market and recognize, how you can navigate and have that growth mindset to position yourself to be successful in a different environment and having that constant evolution and ability to adapt is a really great underlying trait that we think a lot of really high performing GPs are going to have, now and moving forward.
What one question I had there, just to clarify. So you mentioned like 60 to 65% of your portfolio is founder operators, and it sounds like maybe is that going to be the case moving forward? And it sounds like you're mostly curious about like how do we continue to level up their like operational skills that got them there, or I'd love to double click on that for a second.
Yeah, I mean, maybe I'll give an example, kind of on two different
Sure.
sides. The first is a guy named Amada Kuhn, founder and CEO of Mercury, was a part-time partner at YC, serial entrepreneur. He's an active operator building a very seminal company in Mercury. And so, as we think about, what founders need today, how to navigate building a company today, he has that very relevant skill set as opposed to someone that, maybe they started a company 7 years ago. It didn't have any AI. It was a traditional SaaS company. And a lot of that, expertise and know-how and kind of understanding of the founder journey has a shelf life. And maybe for some cases that's expired. I think on the operating side, we've got a fund manager, this guy, Dita von Lohman. He was an early employee at Stripe, was co-founder of a company called Comure alongside General Catalyst. He's seen just about everything in terms of building a company. And that operating skill set, we think, remains very relevant because Stripe and Comure are companies that have innovated and continued to move forward. And we think that skill set is very valuable and also ecosystems that are really important to source from. And so kind of that's how we think about like those skill sets remaining relevant to them being valuable resources to founders, as building a company looks different today.
What if I started a company 15 years ago and I want to be I'm thinking about, I'm like, oh my God, this sounds like me. Do I need to like level up my skill set? Like any tactical advice of like how I can get back into that mentality and fix some of the atrophy that might be happening?
Yeah, I mean, like I said, I mean, build, right? There's all kinds of different tools for vibe coding or different ways to like understand some of the new technical innovations that are shaping how some of the companies are being built today. I think staying relevant with the companies that have, continued to scale, like how do you refresh your network? How do you get an inside look under the hood of some of these companies like OpenAI or Figma and build relationships with those folks that not only might be great future founders, but also have given a glimpse around how to build a really exceptional business today. And then double down on, some of these skills that, are a little bit more enduring, right? Like for someone that's built a business, that founder empathy is hard to replicate. And so, how do you avoid, the personal pitfalls of navigating that and the isolation that comes with that part of building a business and the ability to double down on those existing skill sets that we do think are a little bit more enduring, whereas, maybe there are some others that atrophy over time.
Cool. I love it. Great. Let's move on. Let's talk about Fund One. Um, I'll let you kick things off here, Thomas, because this comes directly from your website and your thesis. But can you walk us through like the kind of the top three things here you're looking for when a GP is raising Fund One, and let's just start there, and then maybe just like maybe a quick follow is what are the most effective ways then for a Fund One GP to get on Cendana's radar?
Yeah, maybe I'll take the latter question
Okay,
first,
perfect.
because I think it's a good piece of advice. I would say, like, by far the best way to get in front of us and frankly, most institutional LPs is trusted network connections. These are the introductions that, get us excited for a call, have us really amped up to talk because, these are folks we trust and know really well. I think historically over 40% of the funds we've committed to originated with an intro from an existing Cendana portfolio fund. So someone, that knows how to get capital from Cendana, someone that knows how to invest in the seed and pre-seed market. And so this goes a really long way for us. Another maybe like unexpected but very effective path is founder referrals. We do a lot of reference calls in our diligence work. It's not uncommon for us to do 30 or 40 reference calls when we're assessing a fund manager. And founders love to share who they enjoy working with. There's obviously multiple people on cap tables, and so doing right by founders is often a good way to get in front of us and get on our radar. Um, the last thing I'd note, because I do think it's important, we've only ever made one commitment from kind of a cold inbound or cold outreach. It's not to say we won't take the meeting. We're actually really big on trying to spend time with as many people as we can. But the Sandana ecosystem is pretty wide now, and given networks are such a big filter for us in our evaluation, there should be a way for you to get a warmer introduction into Sandana if we feel like you have the network that we think is something that's backable for us. And so if the only way in is kind of a cold outreach, that's a little bit of a red flag for us. Um, yeah, and then look, maybe transitioning a little bit to
Sure.
kind of, we put these three filters on our website. We can get into some of the deeper aspects of it as well, but at a high level, portfolio construction, we've got a very clear thesis on the types of funds we look for, right? They're pre-seed and seed only, typically funds 1 through 3, sub 75 million, building appropriately sized portfolios. Like I said earlier, maybe that's call it 30 to 40 companies, with a little bit of margin of error on either side with, lower reserves and kind of a heavy initial check model. Like those are like very simple heuristics. If there are folks that don't necessarily fit some of those, it's a little bit harder for us. That's not to say we won't make exceptions for people that we think are really special, but it's a very good kind of rule of thumb for us as we think about, how we kind of filter through some of this. Networks and ecosystems, I think this is like kind of encompasses a number of different things, but what I would say most is like we are looking for folks that we think might have access to something that no one else does, and are able to source a deal or find a deal that others don't. And we look for kind of enduring, strong competitive advantages on the sourcing side. And so that might look like access into a really great company that has produced really strong entrepreneurial talent, or that might look like access to, a engineering community that has produced really phenomenal technical talent. And so, like, what is that unique edge from a sourcing perspective that's baked into one's network? And then the other piece is access. Do you have the credibility within your network? Do you have the relationships to add value that are going to convince a founder that you are a worthy addition to their cap table? So those are kinds of some of the things we're looking like for network. And then intangibles is a little bit of a catch-all, but there are certain, I think, kind of defining characteristics that we think make great GPs, things like grit and hustle and determination and credibility. We look for folks that have really strong GP market fit. Why is an individual kind of uniquely suited to execute a strategy that might look like someone that built a multi-million dollar company within the space, or maybe it was a family business that they grew up in, or maybe, they made 10 investments in that, including to some of the bigger companies that were produced within those categories. And so kind of we look for that. And then, one of the other aspects we talk about a lot is magnetism, in particular, kind of founder magnetism. Like, why are people going to gravitate towards this individual GP? Is this someone that people would go quit their job to work for? We think that's such a big part of the story for GPs at any fund because one of the biggest roles is how do you attract the very best talent? And so those folks that have that kind of magnetism are something that we really love to see in our GPs.
It's a constrained market right now. We talked about, I think you said a decade low in terms of emerging managers. What are some signals that help you build conviction in like a fund one GP? And we just talked about them at a high level here. But maybe more importantly, like, what are red flags that might end the conversation quickly?
Yeah, I think we covered a lot in terms of what we're looking
Sure.
for. I think the other piece maybe that I would add for fund ones, especially because there are a number of them that, the investing track record is fairly light, and we'll talk a little bit about this, but showing that you have a growth mindset, right? You're constantly iterating, you're constantly evolving, you're able to take feedback and market evidence and kind of incorporate that into your own growth, your fund's growth, and staying dynamic to kind of, build what feels like the best VC fund for you. I think in particular for fund ones, I think that ability to grow with some of the early feedback you get in the fundraise process is a really big part of the story. Um, in terms of red flags, like ego and lack of humility, I think
Mm,
that's kind of one of the number one things for us. We want folks that are willing to learn, want to build together. Like name and logo dropping, I think is to some people one way of fundraising. I think that's something that's a little bit of a turnoff for us.
mm.
We obviously want to recognize that you've got a strong embedded network, but just kind of randomly dropping names or logos is not necessarily the right way of doing that. Um, and then I can't tell you how many GPs come in with their pitch, or just their broader thinking is like incredibly surface level. Like we want to unlock the kind of second and third order of thinking when it comes to, how you're building your fund, how you think about your approach and how it's all bubbled up into kind of what you're trying to build. And I think if you aren't able to show that level of depth, even in an initial conversation, that's a harder fit for
Mm.
us. And then the last piece, and this was a little bit more of a kind of top of market phenomenon, but appearance is like a lifestyle or tourist investor, right? We want folks that, are dedicating their life to this. They view it as kind of their mission, and they're going to run through every wall they need to build their fund, which is no easy task.
Um, But if I am raising fund one, it's what are like the signals? Is it warehouse deals, angel deals I've done? Like, what are like the ways I can showcase you like a track record without actually having deployed capital out of a fund?
Yeah, I mean, angel track record, advisory or sweat equity work, warehouse deals, they're all great ways of kind of showing proof points of, your ability to get access to good companies. I think for folks that, maybe haven't had any capital, I think there are even other ways, for a number of folks, especially if you've got, an operating or founding pedigree, like the companies you choose to work at or what companies you chose to build and at what point, if you joined a company as employee two versus employee 2000, like those are very different stories and I think reflect differently on kind of how you evaluated the opportunity. And so kind of tracking those career trajectories is one way of kind of showing to some extent, your potential investment judgment. We think a lot about, privilege access to high quality networks. Maybe you didn't invest in some of your really intelligent friends that came out of Uber or Palantir, but you were deeply ingrained and you felt like you had the opportunity to access them, and you can kind of tell that story. Especially if some of those have gone on to become, high performing companies. I think that's an important way of doing that. And then, thoughtfulness around your investing framework. I think as first-time investors for many of these folks, to the extent that you've built the rigor and process and depth of thinking around, how do I invest? How do I evaluate companies? Where are my advantages? I think that shows a lot around kind of potential to be a really great investor. And then like strong advocates, in your community, we'll do a lot of reference work. And, we want folks that have demonstrated clear, thoughtful, data-driven decision-making processes. We want folks that, have advocates in their former roles. And then the last piece, and we'll talk a little bit about raising Fund One and kind of tactical pieces of that, but multiple closes are totally fine. We actually advise a lot of first-time fund managers like, look, don't have some artificial number you need to hit. Like if you've got some capital, like do a first close, start putting some capital to work and points on the board. It gives LPs a little bit more to underwrite. It allows you to kind of validate the early strategy. And I think it could be a really good piece, especially for institutional LPs to like unlock that investment potential that maybe isn't as evident with a shorter track record.
Yeah. Okay. I love it. We got 15 minutes left. We're getting a lot of great questions. So I'm going to move us forward here. Um, Maybe we could spend 2 minutes on communicating with LPs for Fund One, and we'll get to some of the Q&A here. Um, what what types of metrics or KPIs do you expect from like Fund One GPs to share early on? Like you mentioned, collaborative team player. How big is communication as I'm starting to deploy capital in Fund One?
Yeah, communication is such a huge piece. And I think one of the things that GPs don't always recognize is, once LPs are invested, like we are absolutely your partners. We want to do everything we can to help you. We want this two-way communication where, you are sharing information flow with us and we can return the same to you. We're really big on that at Cendana. We do monthly calls with all of our fund managers, and they're intentionally no agenda because we want fund managers to show up prepared with not only the key updates on their end, but where we can help them and allow time for that to happen. I think when I look at some of our kind of closest GP relationships, the things that stand out to me are kind of one, the communication is very dynamic, right? It's not limited to a quarterly package that gets sent, every 3 months. It's constant Slacks and emails and WhatsApp messages. So we're, in real time communicating across what's going on in the portfolio where we can help. There's a very high degree of trust, which I think, creates an ability to be more transparent and ultimately creates more fruitful relationships. We want to know the good and the bad, and we obviously treat confidentiality as law. Um, and I also think like one of the things GPs don't always recognize is Cendana is like really rigorous in how we track data. We track qualitative and quantitative data across 5,000 plus companies down to the transaction level. And, we expect our GPs to kind of have that same level of rigor. And so what that means in terms of KPIs and what we're looking for is, we want to see high level fund metrics, of course, but we also want, the more granular data, ownership, entry prices, co-investors for companies. Fundraising momentum is, I think, one that GPs are usually pretty good at. I think, GPs love talking about their markups and things that are going well, but we also want to know, runway, near-term financing plans, which companies are maybe struggling a little bit and what the lessons learned are from those. And then the last piece, which is arguably the most important metric to us, and not something every GP tracks as well as they should, is like the underlying health of the portfolio from like a company traction and operating progress, right? Like we don't want to do an update call or read a quarterly letter and say, oh yeah, this company's doing well, right? We want to know like how is their revenue growing? Who are their customer types? Are they attracting high quality talent? Did they just close a contract? Like those are really vital pieces that we track for ourselves, and we expect GPs to be tracking and communicating to us as well.
Why is it important to you as an LP?
Yeah, I mean, that is ultimately the measure of the health of a portfolio. I think, the days where you can just raise a subsequent round or tell a portfolio based on just the high level performance alone, like markups today are happening 30, 60 days later with no meaningful traction. And so has anything actually been de-risked between those two rounds? No. But, if a company went from 0 to 10 million of ARR with very minimal churn, that's building a real business. That's long enduring value that we can feel comfortable underwriting in terms of where we think this portfolio is going. And we think that's how, again, we talked a little bit about like, if there aren't necessarily markups, how do you kind of show progress? Like that's a great way of showing it. Like, hey, look, our fund managers or our underlying founders are building real companies with very real operating metrics.
Yeah, great. Um, we're gonna hit on one quick slide here with the relevant Q&A question and jump into some Q&A with 10 minutes left. Um, so kind of transitioning now from fund one to two, we had a question come in, I think, which is a great kind of cover for this slide. What sets apart fund one managers who built iconic franchises from ones that struggled with fund two? And did you see any early signs that like the ones that did not transition to fund two were gonna like, are there early warning signs or indicators I can start thinking about?
Yeah, I mean, first off is like ability to show that you were able to execute on strategy. I think if you raised a fund one and said you're going to do X, Y, Z, and none of those have come to fruition, those are obviously concerning signs as we think about, graduating to fund two and what we're looking for. I think like losing the magic of what made fund one successful is a pitfall a lot of folks fall into. And I think the really great fund managers that are able to build enduring franchises rather than getting caught up in hype or moving away from the things that made them successful in fund one, they kind of double down on those original edges. And so, if one of your hallmarks was you were able to source from, high quality co-investors and all of a sudden you're saying, "Oh, I'm not collaborative, I'm a lead fund now," you've diminished a big part of your strategic edge.
Hmm.
And so the ability to do that is really important. I think the other dynamic is, Fund two is not a decision that happens when it's launched. Fund two starts from the very beginning, and how do you build your firm foundationally from the ground up? I think folks that kind of fly by the seat of their pants or are trying to build the plane as you're flying, I think struggle to create more enduring franchises. But folks that are constantly thinking about what are the right resources that I need, or how do I continue to elevate my strategy or my process, or what are accretive areas, whether it be community or research that I can add as part of my fund two to become more compelling to founders and subsequently LPs. And then I think just continued discipline, building a venture franchise takes time and you're not going to go from 50 to 500 right away. And so recognizing, what some of the different steps are in between and how you kind of walk and before you run and build that from kind of first principles is a really important part of like I think what the fund twos that have been successful from our perspective in terms of not only raising that next fund, but being able to endure into a long-term franchise.
Right. I'm going to switch right into our Q&A here. We'll send out the last slide kind of around fund two, and a lot of the questions are related to this. Some tactical ones too, which are great. What's Cendana's expectation for GP commits? How are management fee offsets viewed for GP commits? Is that a red flag?
Yeah, I mean, look, every GP has their own individual circumstances, and I think that ties into a lot of this. I think the place we draw the line is we want to see a GP commitment that is meaningful to the fund and meaningful to the individual GP. For some, that might look like 1%. For others, that might look like 3 or 4%. For some, it might be all cash. For some, there might be a meaningful percentage that's kind of an offset. The way we think about it and Cendana itself, we do want to see some cash portion of it. So, Cendana has kind of a portion that's cash, a portion that's kind of management fee offset. We think that's fine, especially for, more emerging GPs. But the reality is, we want our GPs to have the same level of alignment and a desire to put their own personal capital into their fund because they believe that's the most high performing asset that they can invest it into.
Thank you. In today's tough market, are you investing more in the team behind the thesis or the thesis itself, becoming more active partners or sticking to like a traditional funding role? It sounds like you are a very active partner. So maybe just the first part of that question, which is the team or the thesis.
Yeah, I would say like at the end of the day, we've got all this data, we've got theses, whatever. Um, but I do think to the majority of the perspective, it's who the individual GP is. What is their credibility? Do they have the networks? Do they have the capabilities of pulling off that strategy? Because someone might have an amazing strategy, but if they're not the right ones to execute it, then that doesn't really matter. And so I think we skew quite a bit more towards kind of the individual GP and their reputation and betting on them. But we also want to see, thoughtfulness around kind of how they align all of that with their thesis. That's kind of this kind of GP market fit I was referencing a little bit earlier.
Um, how deeply do you evaluate, like, how do you evaluate the deal flow quality now in the durability, but like in the access I might have today? But how do you think about that, like with years to come, right? Like 10, 15 years. Like, yeah, I might have a great network now. How are you evaluating that for the future?
Mike, that is such a great question and something that we spend a ton of time on. And candidly, the answer is like it's really hard to reinvent your networks when you're on fund four or fund five and you've exhausted a lot of the things that have, been really valuable sources for you. I would say, the piece that we think about a lot is like how do you get that flywheel spinning, right? Like obviously as you build a portfolio of founders, if you are a really highly value added partner, you do right by them, you're able to produce, high quality companies, that kind of success drives additional success, right? You get founder introductions. Some of these companies might end up creating, these mafias or, really, really strong pools of entrepreneurial talent that become, really big pillars of ecosystems. And so I feel like that kind of founder referral success begets
Hmm.
success flywheel really starts spinning. But I also think, you've got to continue to reinvent and, maybe you are sourcing from a company that isn't as interesting anymore. Maybe the founder profile looks a little bit different. I mean, I think we talked about this earlier, but, there are 17, 18-year-old kids building really big companies today. And so how do you find new ways to access some of these different talent pools, are all really important questions that we think, GPs need to be constantly evaluating, ways to refresh and innovate their sourcing channels.
Okay. Two questions before I wrap here. As a fund of funds, you're naturally exposed to the double fee challenge. How do you think about balancing economics between LPs and GPs you back? Any innovation in fee structures that could make this more sustainable?
Yeah, I mean, look, on the fund of fund side, we show everything net of fees and we think about the performance we share to our LPs as kind of net of all fees, and we want that to be competitive with the venture market. And so that's kind of how we think about it. I think there have been different fee structures that have been introduced. I think one of the kind of newer areas is like tiered carry or premium carry as funds,
Mm,
generate stronger performance, which I think, is an earned right. I think folks that have proven the ability to, produce really high performing track records, that's something that they've earned. I don't think it's something that, first time GPs can just walk into. But we do think, kind of that like underlying alignment of like, look, you'll do better when we do better is a really important piece. And at the end of the day, we want to back GPs that are aligned with structures that they make their money on carry and not management fees. And so, folks that are kind of AUM gathering are not usually what we are looking for from the
mm,
investment perspective.
yeah. One very tactical question before we wrap, but it was one of the first ones that came in, so I want to make sure we get to Benjamin's question here. Has Cendana invested in any venture studios or considering doing so in the future?
Yeah, it's a great question. We've not invested in any venture studios. We've got a handful of funds that, might incubate one or two deals as part of the fund. And we backed one international manager that's got an accelerator element. We've got a couple in the US that have that baked into their core fund as well. We've not backed like a traditional venture studio. I think it's a really innovative model. I think we've got a couple of like internal concerns around like the missionary versus mercenary dynamic of kind of founders entering and building in that vision. And I think this ties to some extent a little bit to, where we started the conversation around the changing seed dynamic is like
Mm,
there is no shortage of capital chasing really great founders and really great business ideas. And, depending on the economic structure for some of these venture studios, it's not necessarily the best or most attractive for the very best founders. And so, we do have some concerns about is there, baked in adverse selection. None of that is to say we won't back the right venture studio that we think is a really strong fit. And we've spent quite a bit of time getting to know folks. We've just got a couple of those hurdles that, we're waiting for the right fund to show us why we're wrong on.
I love it. Well, we're gonna end it there. Um, Thomas, thank you so much for spending an hour with us. Clearly, you're an expert, and just really appreciate all your insight and just all of your takes with us today. I think it's super helpful for not only founders, but sorry, not only GPs, but also founders. So thanks for that. Again, everyone, will send this out, and we'll see you out there on the street.
Perfect. Thanks so much, Mike, Matt. This was really wonderful, and thanks everyone that joined.
All right, take care.